We're going to have a sovereign debt crisis, a currency crisis. The Fed has to pick which one. Ultimately, we'll probably end up having both. But initially, they're going to have to choose between causing a financial crisis that's worse than '08 with no bailouts, right? So that means real serious losses.
Hey guys, welcome back to Everyday Finance. In this video, Peter Schiff discusses about Fed market. According to Peter Schiff, the economy officially enters a recession at the already horrifying deficits, which total more than $2 trillion annually, would likely double the $4 trillion or more, and that will produce inflation since the Fed will issue money to profit from all that debt. In fact, the weaker economy will cause inflation to rise, and the explanation for the decline in inflation as indicated by the CPI from 9% to about 3%, and it's already starting to trend upward again. This isn't because of the rate increases. Rather, the rate hikes were the reason of the dollar to rise, and the robust dollar contributed to the decline in the price of oil and other commodities, as well as the CPI is declining. But Peter Schiff believed the dollar has peaked and is about to give up all of those gains. In fact, looking at what transpired this past week, it was a notable, in my opinion, reversal outside of a reversal, where the dollar index closed well below the previous week's low, despite breaking over the previous week's high this week. And Peter Schiff believes the dollar is set to fall. Therefore, if the dollar has reached its peak, it indicates that inflation has inserted a bottom, and lots of things Peter Schiff discuss. So please watch the video to end and share, subscribe our channel Everyday Finance, thanks.
Going to be reflected in the markets, but I think the traders have got it wrong. They believe that a weakening economy means a weaker inflation, that if we have more people unemployed or not as strong an economy, that we're going to have a reduction in inflation. And they've got that wrong. And that's because they have Keynesian belief that inflation is a byproduct of economic growth, that a strong economy creates inflation. And that's not true. Actually, a strong economy helps counteract the inflation that the government creates. The government, the Federal Reserve, and deficit spending is the source of the inflation. Now, sometimes the inflation can be masked by a strong economy, which is productive and turning out more goods and services for that money to buy. But like the jobs numbers that we just got are highly inflationary. The markets don't get that because we lost productive jobs. We gained non-productive jobs paid for by the government, which means bigger deficits. As the economy falls into an official recession, the deficits that are already horrific, that are over $2 trillion a year, are going to probably double to $4 trillion or more. And that is inflationary because the Fed is going to be printing money to monetize all that debt. The weaker economy is actually going to send inflation higher. And in fact, the main reason that inflation came down as measured by the CPI from 9% to about 3%, and now it's already trending back up, it wasn't because of the rate hikes. It was because the rate hikes caused the dollar to go up. And it was the strong dollar that brought down oil prices, other commodity prices, and helped bring the CPI down. But I think the dollar has topped, and I think it's about to surrender all of those gains. And in fact, if you look at what happened this past week, it was a significant, I think, outside reversal, where the dollar index took out the high from the previous week, yet closed significantly below the low from that prior week. And I think the dollar is about to drop. And so if the dollar has put in a top, that means inflation has put in a bottom. And that's going to be a very difficult predicament for the Fed, because just as the economy is weakening, inflation is going to be strengthening. What do?
According to Peter Schiff, there will be a sovereign debt crisis. Then the Fed must decide which currency problem to address first because of a financial crisis. In the end, we'll probably have both. But initially, they have to make a decision, emergency that represents extremely significant losses, not just at a bank and is worse than 2008 without bailouts, correct? Fails, and every major bank that we helped to prop up in 2008 will fail. Only this time, it will be even worse, devastating collapse. But it also implies that because there is no money in these institutions, depositors would lose money the FDIC to restore these bankrupt banks to full capacity for the depositors. Therefore, the Federal Reserve will need to either approve a significant financial collapse or the sacrifice of anything in order to stop.
Well, we're going to have a sovereign debt crisis, a currency crisis. The Fed has to pick which one. Ultimately, we'll probably end up having both. But initially, they're going to have to choose between causing a financial crisis that's worse than '08 with no bailouts, right? So that means real serious losses. It's not just that a bank fails. And all the big banks that we bailed out in 2008 will fail. And they're much bigger now, and it'll be a much more disastrous collapse. But it means that depositors at these institutions will lose money, because there is no money in the FDIC to make these, insolvent banks whole for the depositors. So the Fed is either going to have to allow a massive, financial collapse, or in order to prevent that, it's going to sacrifice the dollar, and it's going to surrender in its inflation war, and it's going to allow much, much higher inflation than, they're going to have to stop pretending that the goal is 2%. I mean, we're going to be much, much higher. We'll be in the double digits. Well, whether it's ever going to officially wave that flag, or the markets are going to have to figure it out just based on what the Fed is doing rather than what it's saying. But you're looking at the foreign exchange market, watch what happens to the dollar. If I'm right, if we really start to break down on the dollar, if gold takes off, gold's been hanging out around 2,000. It hasn't been able to really break above it. I think when we decisively move above 2,000, maybe 2,100, we hit a record high. Gold will probably never trade below 2,000 again, and we'll have a solid base of support. And when the gold price really starts to get closer to 3,000 and 2,000, which it can do very quickly, that's really, a warning sign to the world that, we're out of room here. That there is a crisis of confidence in the Fed, in the dollar, in the Treasury market. And we start to see the long end of the curve really starting to get hit. 30-year Treasuries are now back below 5%. They're like 4.85 or something. But the curve is now normalizing somewhat, because the yield on the 30-year didn't go down nearly as much today as on the 10-year or as the 5-year. But we really start to see the yields blowing out because rates are going a lot higher. That's when it's going to hit the fan, because now the economy is going to start reacting to this big backup in rates. The commodity prices are going to start reacting. Oil prices are going to react to the weak dollar. All that's going to obviously start showing up in CPI. So you're going to start to see these inflation numbers moving up as the economy is weakening. We're going to start to see a big uptick in unemployment. And, the Fed is going to have to choose. And I think publicly, especially, it's an election year next year. And if unemployment is rising and the economy is weakening, the Fed is going to go for stimulus. Well, stimulus is inflation. That's all stimulus ever was. That's the only arrow in their quiver, is inflation. That's what quantitative easing is. It's inflation. It's a euphemism for inflation. And they're going to go back to that. They're going to abandon quantitative tightening. They're going to go back to quantitative easing, even as inflation is well north of 2% and rising. And then the markets will figure this out, and then, the currency will collapse and inflation is really going to break out. And then the Fed is going to have to decide, is it going to do anything to rein that in, or just allow, hyperinflation?